Hi, I'm Sebastian Mullins, head of multi-asset and fixed income at Schroders Real. Markets continued to rally this quarter, with equities up 5% in local currency terms. The standout performer was EM equities, emerging market equities, which rallied 9% over the quarter in US dollar terms, mainly due to Chinese equities given the government stimulus that came out this quarter. However, it wasn't a smooth ride. US equities were up 6% in US dollar terms over the quarter, but they had two drawdowns, one of over 4% and one of over 8%. What caused the larger drawdown was the fact that job numbers came out in the US weaker than expected, which led to recessionary fears percolating in the market. This allowed the Federal Reserve to cut basis points by a jumbo of 50 basis points, or 0.5%, to help stimulate the economy and stimulate growth. That volatility was also exacerbated not only by the recessionary news, but by the unwind of the yen carry trade. What we saw is the Bank of Japan raise interest rates by 0.15%, or 50 basis points, to get their cash rate to 0.25%, or 25 basis points. That caused the yen, the Japanese yen, to rally 15% against the US dollar from trough to peak during the quarter, and caused Japanese equities to fall 25% peak to trough during the quarter, although it recovered pretty quickly thereafter. We saw US Treasury yields in the US 10-year fall 60 basis points from 4.4% to 3.8%, which resulted in a 4% price return for US 10-year Treasuries. Credit was also volatile, with spreads widening and contracting over the quarter, but ultimately ending up tighter and delivering 5% price returns both in US investment grade and US high yield. In currencies, we saw the US dollar weaken, mainly against the Japanese yen, as I mentioned, but also against the euro, the British pound, and even Australian dollars, with each of those rallying around 4 to 6% against the US dollar. The Schroder Real Return Fund wholesale share class delivered 3.4% net of fees for the quarter, bringing the one-year return to almost 14% net of fees. Most asset classes contribute to that strong performance, particularly equities, but also duration. Our position in the US front ends really benefited from the fall in interest rates and the Fed cutting interest rates during the quarter, delivering significant returns, along with global equities. Global credits, as well as insurance and securities, also contribute to performance. Commodities were a minor detractor, along with FX. We have an allocation to US dollars, which detracted over the quarter given the weakness in US dollar. However, by having more Australian dollars and less foreign currency, this helped the portfolio, along with our allocation to the Japanese yen, which performed very strongly, and emerging market currencies. We continue to be firmly in the soft landing camp and believe fears of recession are overblown, especially in the US. US GDP continued to grow and perform above expectations and above trends for the second quarter, with GDP coming in real GDP at 3% for the quarter. And GDP nowcast from the Atlanta Fed is now showing 3.2% expectations for this quarter's GDP, well above trends. You can see here on the left-hand side that growth has been increasing over time, given the slump we had in the first part of the year. On the right-hand side, you can also see that the beliefs that jobs were starting to fall in the September quarter, which caused some of the market volatility, was overblown. With revisions occurring, we did see weaker than expected job numbers in the August prints for July, but that's predominantly due to more people joining the workforce from immigration, and also hurricanes affected people getting to work or being able to actually reach their workplace, causing unemployment to temporarily spike higher. However, since then we've seen revisions take that out, and private sector job growth is actually increasing quite dramatically, as you can see on the right-hand side. So for us, fears of job layoffs and recession in the US continue to be overblown. However, that weakness we saw during the quarter in job numbers did allow the Fed to cut by 50 basis points, which is a jumbo rate cut. Expectations were either 25 to 50, so going with the 50 was quite dovish. Now, it's quite rare for the Fed to cut rates, especially by that magnitude in one hit, when growth is strong. We mentioned above trend growth in the US. Employment is around full employment. Employment's below 5%, it's coming around 4%. And we actually think that earnings growth is going to continue to be positive, with expectations being in the double digits for US equity earnings growth. So cutting rates with this supportive backdrop is quite bullish for risk assets, because the Fed is cutting rates because inflation is coming down, as opposed to growth significantly weakening. What's also positive is the US consumer remains quite strong. They continue to consume, and they also ensure that they're quite insulated from the recent rate hikes. If you look on the left-hand side of this slide, you can see consumer balance sheets are in great shape. They cut their debt to GDP dramatically after the 2008 financial crisis, and are sitting at pretty healthy levels of debt right now. At the same time, they've seen real wage growth explode over the past few years since COVID-19. So for them, they have lower debt, high real wage growth, and if the Fed is cutting rates, it might actually allow them to re-lever. With that re-leveraging comes more consumption. Even with that re-levering, on the right-hand side, you can see that retail sales is picking up again. After slumping in the first half of the year, it's now accelerating again as consumers are using that wage increase to spend and actually seeing their wealth increase because of asset prices moving higher. So for us, we do believe the consumer will continue to spend, which will support consumption and therefore support GDP, especially in the US. If we think about what that means for equities, if we're positive on the cycle in the US, we're positive that soft landing is most likely. The Fed are cutting rates despite having a strong economy and strong earnings growth. The question is, are we bullish on equities? The long and short of it is yes, we are bullish on equities. If you look at earnings and valuations, I should say on the left-hand side, the US does stand out as being a particularly expensive market. You can see there it's above every other market in terms of its PE ratio, but also above its own historical norm. Now that by itself is cause for alarm. But looking beneath the surface, a lot of this is accounted for because of the compositional shifts by having the mega cap companies being more of the index than they were in the past. But those companies are not unprofitable tech, like we saw in the dot-com crash and even 2021, where companies with no earnings were bid up very expensively. These are actually very strong, highly cash flow generative companies like Google, like Apple, like Amazon. So for us, while the equity market is expensive for a reason, because the quality is strong there, earnings are expected to continue to be strong there. And you can see on the right-hand side, our US earnings model, which is a top-down macro model, supports earnings growth for the next year or two. So for us, while the equity market is expensive, we still believe the cycle is supportive and the earnings will grow. Other economies like Australia also look expensive, but with less catalyst for that to rally further, whereas Europe and the UK look around average, and Japan is slightly cheap, especially after the sell-off we saw in the September quarter. So for us, we do still like US equities for their quality and Japan for the valuations. But if you look on the next slide, on the left-hand side, you can see that earnings expectations for ex-US companies start to improve next year and the year after. So while we still prefer US equities now, there is a catalyst for global equities to start outperforming next year and the year after. Even within the US, we expect a rotation from those mega cap companies to the more cyclically or economically sensitive parts of the economy. So we've been shifting our allocation away from the S&P weighted index to an S&P equal weight index, which reduces the mega cap companies and increases the other companies in its weighting. So that's how we're sort of playing this rotation in US equities as opposed to moving offshore into Europe, etc. in the interim. US equities can also benefit from a reduction in US Treasury volatility. On the right-hand side, you can see as bond volatility falls, PE ratios can actually rise. So for us, we do remain positive on equities despite some of the valuation concerns we see in the US. When it comes to duration, we remain negative. We believe having duration in your portfolio will protect you from recessionary risks, but that is not our base case. And because that's not our base case, we do believe too many cuts are priced right now in the market compared to our belief of the strong US economy, and also compared to what the US Federal Reserve are telling you their expectations are for cash rates. If you look on the left-hand side, you can see the dotted line, which is the market pricing, compared to the thicker line, which is the Federal Reserve's own expectations. There's a disconnect there. We believe the Fed's expectations are more likely, and the market expectations have gotten ahead of themselves. So we remain negative on duration, especially in the US, given our view on the cycle. However, countries like Australia that have very few rate cuts priced, we prefer, given inflation is moderating in Australia. And we also like Europe, where the economy is far weaker than the US, so having duration there makes more sense. So overall negative on duration, but preferring Europe and Australia to the US. In credits, we remain neutral. However, there are pockets of opportunity within the credit universe. Here we have a credit percentile, which shows what credit spreads are relative to their own history. Green means they're very wide and cheap. Red means they're very tight and expensive. You can see most credit markets remain expensive. Now that doesn't mean we think credit spreads will widen, particularly given our positive view on the US economy. And we are seeing default rates roll over in the US, which is positive for credit. However, we find better value in countries like Europe and Australia, as well as securitized credit. So in the US, we prefer to have securitized over corporate bonds. And within corporates, we prefer Europe and Australia to the US. Finally, in currencies, we still believe that having a US dollar allocation is a good hedge. US dollar tends to rally in a recession, but also if those rate cuts come out of the market and the economy improves, US dollar should rally. And that believes in the US dollar smile complex, where we believe at the bottom of the smile right now. So for us, we do hold US dollars as a hedge, but we prefer currencies like emerging market currencies to give us carry, and the Japanese yen as a hedge, particularly because we think the Bank of Japan will continue to hike rates. We used the market volatility in the September quarter to continue to add to risk in the portfolio. We used the sell-off in August to add to US equities and also Japanese equities after they fell dramatically in the August period. We also saw volatility spike quite dramatically with the US VIX index jumping to the third highest reading since the last 20 years. So we sold volatility to capture some of that volatility premium in the portfolio. We saw our equity weight increase as markets rallied towards the end of August, bringing our overall equity weight to 43%. But we then took some profit and brought that down to 38% by the end of the quarter. So right now we're sitting at 38% equity in delta adjusted terms in the portfolio. What we've also been doing is allocating to credit. We saw credit spreads widen during the period, so we had a little bit too high yield, particularly in European high yield, spreads remain more attractive compared to the US. Within equities, we've also been rotating some of our allocation away from Australian equities towards global equities. And within global equities, we've moved some of our S&P allocation to an equal weight S&P allocation to help diversify away from those mega cap tech names and move towards more the cyclical part of the US universe. When we saw duration rally, we took profit, bringing our duration down from around 2.4 years down to 1.5 years. So almost a whole year reduction in duration by taking profit on the US front end and also the European front end, which rallied the most during the period. In terms of currencies, we took profit on our long Australian dollars by adding another 5% to foreign currencies, mainly Japanese yen, European euros, and CAD, Canadian dollars. We also add a little bit to emerging market FX to help with carry on that portfolio. We continue to hold allocation to insurance-linked securities and inflation-linked bonds because we do believe inflation is going to be higher than expected. Finally, we continue to hold a 10% notional allocation to put spreads in the portfolio, which would protect the portfolio if we see a market drop between 5 and 15%.